All right, lesson 15.2, adjusting merchandise inventory and interest receivable. So let's just get into merchandise inventory first. 3 Green uses the periodic inventory method. So during a fiscal period, and if you remember, a fiscal period is a period of time set by the company. It has to be 1 year, but it can start anytime during the year that makes the best sense for that company, for that business type. So during a fiscal period, all purchases of merchandise are recorded in purchases. No changes in the amount of inventory resulting from purchases and sales are recorded in merchandise inventory. So as a result, the balance of merchandise inventory on December 31st is written down, and it has not changed from its January 1st balance. So going here, the amount of inventory on hand at the beginning of a fiscal period is called the beginning inventory. And then during this period, like I just said, merchandise is purchased and merchandise is sold. So to determine how much merchandise remains in inventory at the end of the period, a physical inventory is conducted. Remember, a physical inventory is where they physically go in and count each item and write it down. Physically, like people are out in the stores or out in the warehouses counting things and writing them down. It's a big deal. So the actual count of merchandise at the end of a fiscal period is called the ending inventory. Actually, we're going to stop there for a second. Some businesses conduct physical inventories more frequently. So for 3 Green, the balance of merchandise inventory account at the end of the fiscal year must equal the actual ending inventory balance, which is why you would need to adjust something. So for 3 Green, the January 1 inventory was written at 108,486.44. Okay, December 31st, the physical inventory was counted at $102,838. So we need to adjust things. Most accounts needing adjustment at the end of the fiscal period have a related expense account. So accounts needing adjusted and the related expense account. So for instance, an account needed adjusted, so when prepaid insurance needs adjusted, the related expense account is insurance expense. But when merchandise inventory needs adjusted, we don't have a related expense account. So they've created income summary, which is a temporary account. So remember, income summary is a temporary account that gets closed when they finish the whole process. All right, moving on. So if we go here, this is where we're going next. I'm going to get back off this slide and explain the 4 questions again. If you remember, we ask 4 questions every time we have an adjustment. So let's do our 4 questions. 4 questions, can't spell, to ask every time you adjust. 1. What is the balance of the account being adjusted? Okay, we just said merchandise inventory was $108,486.44. Next question. What should the balance be for this account? We just said that one too. Also, merchandise inventory should be at $102,838. Question 3. What must be done to correct the account Goodness, balances. Well, we need to decrease the merchandise inventory by 5.6. How did we get that number? Well, pretty simple. 108,486 minus 102, and there we go. Last question. What adjustment is made? Well, we're going to debit income summary, that's our temporary account, by 5,648, and credit merchandise inventory 5,64844. Okay, so those are the 4 questions, and that's what we do right here. Okay, we've got merchandise inventory. We need to adjust it to get our new balance, and income summary is our adjustment. Okay, this is our trial balance. That's where it shows merchandise inventory originally. We have a debit and income summary right there, debit and a credit and merchandise inventory. I'm going to pause this for a second. All right, I had done a new slide for this and I couldn't find it, so I found it. Let's move on. So we answered those 4 questions. They were on our sticky notes right there. And we already did this. Good job. Now, recording and adjusting entry for merchandise inventory. Unlike sales on account, some revenues are earned over time. Notes receivable, earning interest income every day the note is outstanding. Remember, when a customer doesn't pay you the day that they get their product, you can issue a note receivable and it will earn interest. It's usually like a 90-day and a certain percent of interest. Well, that's a per day interest, and it would be impossible to make a note, make an entry each day the note is outstanding. That just would be tedious. So what we do is we take, this is an example, if we had a $10,000 note at 9% interest, per day, you just, right here, the 1/360 is your per day. So for instance, if the note was outstanding for 20 days, you would replace this 1 with a 20. Your $10,000 times your interest rate times the amount of days that it was outstanding. So let's do an example. Actually, going here. Revenue earned in one fiscal period but not received until a later fiscal period is called accrued revenue. A company must identify the period of time for which the accrued revenue should be recorded. The number of days is used to calculate the amount of the adjusting entry. The adjusting entry for accrued revenue increases a revenue account, which is a credit, and increases a receivable account, which is a debit. Yep, we're good. So, we need to open up the slide. Interest earned but not yet received is called accrued interest income. Interest receivable, debit increases, credit decreases, and then interest income, debit decreases, credit increases. So a note receivable, 90-day, 9%, a $6,200 note. It's dated November 1st. Well, if we're doing our ending balance December 31st, November 1st to December 31st is 60 days. So November to November 30th is 30 days, and then the 1st to the 31st, another 30 days. And we have 60 days total. So our math is 6,200 times 0.9 times 30 divided by 360. 6,200 times 0.09 times 30 divided by 360. That didn't work. Oh, I did 30 days. Okay, my math is wrong. My slide is wrong. Let's try that again. Times 0.09 times 60 divided by 360. $93. Let's change that. Okay, and then we ask the 4 questions because we wanted to do our adjustment. Well, let's ask our 4 questions. Okay, we're going to use the same slide, the same post-it note, because the questions are the same every time, right? All right, what is the balance of the account being adjusted? Same first question. Interest receivable. And that is 0. Okay, we don't have a balance there. What should the balance be for this account? Same account. Interest receivable should be $93, which is what we just calculated. What must be done to correct the account balance? We need to increase by $93. And then what adjustment is made? Debit, interest receivable, $93, and then credit, interest income, $93. Let's go to our slide and see it. Okay, so what we talked about, interest expense, interest income, gives us a new balance. Notes receivable, $6,200. Interest receivable was 0. We need to actually give us a balance in interest receivable. All right, that is it. So how is the amount of merchandise inventory on hand at the end of the fiscal year determined? We go out and we count. It's a physical inventory because we physically do the work. What adjusting entry is recorded when the ending merchandise inventory is greater than the beginning value? We debit merchandise inventory and we credit income summary, which is backwards from what we did. In our example, we debited income summary and credited merchandise inventory because our beginning inventory our beginning was greater than our ending. Here, ending is greater than beginning, so it's backwards. How often is revenue earned on an outstanding note receivable? Daily. Okay, but that's why we do the number of days divided by 360, because we don't want to make an entry every day. What types of accounts are increased by recording and adjusting entry for accrued revenue? The adjusting entry for accrued revenue increases the revenue account, which is a credit, and increases the receivable account, which is a debit. That's it.